This is Morning Stock Watch with the weekly report for the week ending 28 February 2020. This report includes the broad market along with Netflix and Tesla. First starting with SPY. SPY weekly closing price $296.26, down 11.1%. This week the SPY had extreme selling that we expected near the 340 area, closing just below $300 support. This appears as a very large red engulfing candle erasing over 6 months of gains. Other areas of weekly support on the chart are around the $312 area. A Fibonacci and moving average cluster blown through like a hot knife through butter. The momentum was strong, even it pierced through the bottom retracement support. Also in this area, the 100-period moving average and the green Kumo cloud, which all created added support, which explains the bounce we've had. News coverage on this leg of the crash tells us that it's primarily due to the coronavirus, which it may be. It's pretty serious. But the charts alone have been giving crash warnings for some time now, so this is definitely not a surprise. The overall trend of the market has been extremely bullish, but visually appearing overextended on the chart, with decreasing volume, with higher prices going into 340. On RSI, the weekly chart continued to have very strong overbought negative divergence, with the first and second peaks on January 22, 2018 and January 13, 2020, about 2 years apart. This negative divergence is completed, which means that there are two complete overbought tops, which means both tops are diverging negatively with respect to price, while both of these tops are above the measurement of 70 on the RSI. The chart shows overbought conditions in red. This week we've seen the market crash as much as 20% from the highs of 339.08, just below 340. It's just a coincidence that the coronavirus brings down the market just right when the market was fat and juicy for a flush. Just saying. Shifting focus to other areas of the broader market, simply looking at the weekly candles in comparison with the SPY. On the end of Friday, I remember seeing some CNBC alerts saying that the chip stocks started to make a comeback. And we can see that in QQQ, SMH, and XLK, all being saved by the 50-period moving average, in turn buying up the NASDAQ off of those levels as well. So it looks like the tech stocks saved the market from actually closing the week even lower than it did, for now at least. Probably the biggest concern I see is how the VIX looks this week. The VIX can simply be thought of as a fear gauge that tracks anticipated volatility in the market. The higher the VIX, the market is seen as more volatile and usually makes sharp peaks during crashes. These peaks are many times seen as good areas to get into the market. However, this week we see the VIX close at a 40.1, which the market has not seen since 2011 and 2008. We've seen some crashes since 2008, but the VIX quickly decreased and managed to close the week with very long upper wicks on the week. The week beginning May 3rd, 2010 looks most comparable to this week, minus the upper wick we have now. We can see that the market had some additional selling during the next couple weeks after the crash, and then a recovery. I'm not going to get too deep into this, but there will be a lot of people trying to guess where the bottom of this market crash will be. So now where do the markets go from here? Knowing that the market could easily choose more downside, let's look at a couple areas of support scenarios. For this, I have a 20-year chart going back to the year 2000. There's only one other area on this chart that's similar to the weekly divergence that we have now, and that's the one that leads right to the crash of 2008. The difference is that the 2008 crash divergence was a lot more steady than the one that we're in now. Current price has really made a lot of upside very quickly over the past 2 years, so price could come down even faster. To what? If this was to be anything like 2008, which this crash potentially could be way worse than 2008, then price for the SPY could eventually make it to the floor of 215 or so. For the time being, the market is due for a bounce at support, and maybe some upward consolidation up to 315, and then for another leg down. This is one of the many scenarios that could happen, but is one that looks pretty probable. Another is that we could see price open lower on support, attempt a bounce, and then fail, closing into the green cloud, creating another immediate leg down. This is not as probable, but could still happen. Next, we have Netflix. Weekly close price, $369.03. Netflix held its ground really well throughout the crash so far. This has a very bullish tone to it for the stock of Netflix. Price did come down to around the 365 area with lows of 357, during some of the worst parts of the market crash. Last week we spotted some continuation divergence on the last two bottoms. This is where price is making higher lows as the indicator is making lower lows. And the last two tops have positive weekly divergence. Last week we also looked at the thick green and blue lines on the chart. These had very strong upward angulation that appears to have helped price remain above the wedge for the duration of the market crash. Again, the move for Netflix right now looks like it still wants to do some kind of a bull flag pattern. This is a period of downward consolidation, and then another thrust above 385. Let's see if Netflix can hold above the wedge until another market bounce.